Hi everyone, this is Alan again, and I'm the blogger behind The Practical Saver. For today's episode, I will discuss with you some tips on how to get started with investing. A couple of years ago, I was an investor. I made significant mistakes when it comes to investing and lost a lot of money in the process. But I've learned so many things about investing, and I've used those learnings in order to move forward and have significant improvements in my investing habits and my net asset as well. So the first thing that I need to tell you before we go deeper into those tips is that investing is not for the faint of heart. So why did I say that? I said that because in investing, you can make a lot of money, but on the other side of the token, you can lose a lot of money as well. So when it comes to investing, you need to be aware, or you need to be cautious on what investments are you going to put your money in and things like that. So the very first thing that you need to do when it comes to investing or getting started with investing is to know your risk tolerance. When I say risk tolerance, is you need to understand how comfortable you are with investing. Are you afraid into investing and losing a lot of money, or are you okay or fine with investing money with a chance of losing a lot of money, but at the same time gaining a lot of money if your investments go well? So the very first thing that you need to do is to assess your risk tolerance. The second thing on my list is that you need to do your research first, a thorough, well-developed, in-depth research first before you put your money into an investment, whether it's an investment A, investment D, or things like that. You need to understand what the investment is all about, what their purpose is. You need to look into the prospectus. You need to look at the risks and the possible rewards. You need to look at the fees and management fees as well, and things like that. You need to understand inside and out what those investments are for and what those investments mean. The third thing on my list is to diversify your investment. So when you started putting your money into the investment, whether it's a stock market or real estate or something else, you need to diversify your investment. Don't put your money in one basket. The reason why, if that basket goes down, your money will go down as well. But if you have different kinds of investments here and there, when one goes up and one goes down, it kind of balances out. So it's really highly recommend, or I highly recommend, that when you put your money into investments, that you need to diversify your portfolio. The fourth thing on my list is to take out emotions from investing. Investing should almost always be logical. When you put emotions in it, it's a hassle. You're gonna face a lot of major problems. For example, when your emotion is high and you see the stock market is falling down, the very first thing that you're gonna think of is I need to pull out my money. And once you pull out your money, you're basically losing money as well. So take out the emotions from your investing and be as logical as possible. So the next thing on my list, or my recommendation, is to start investing early as possible. My reasoning behind this lies within the concept of compounding interest. So in layman's term, compounding interest is when your capital and the interest in your capital grows and adds up interest on top of interest on top of interest and things like that. So when you start early or when you start young, your investment has a greater chance of growing because of the interest that your investment will accumulate in a certain period of time. So when you have a chance, start investing early. So the next thing on my list, or my recommendation, is that you start with a small amount of money. So the reason why I say that is because the ease and the comfort are not there yet when you are a new investor. So you're not comfortable yet. You're not at ease when it comes to investing. So it takes years to know the ins and outs of investing, to know the risks involved when it comes to investing and things like that. So we start with the small amount of money instead of putting everything or putting a lot of money into it. What it is, I'll give you an example. If you put in $50,000 right away into an account and you are a new investor, when you see that 50,000 goes down day after day after day, your feeling when it comes to investing might change. So, but when you start with a small amount of money, you won't feel as bad when you see your investment goes down. So that's why I highly recommend that when you are a new investor, that you may want to start with a small amount of money first before you gradually increase your investments and put money into it. And that's all I have for now. I hope you got something out of my video blog. I hope you learned some tips and tricks into investing when you are a new investor. If you have any questions, suggestions, and or recommendations, please put them on the comments below. And if you like, you can subscribe into my YouTube channel and visit my blog, The Practical Saver, which is www.thepracticalsaver.com. In there, you'll see a ton of blog posts in regards to saving money, making money, and things like that. So, bye everyone. See ya. Bye.